So how I review a deal from start to finish. Whenever you get a deal, you always ask for offering memorandum. It's almost like a flyer from residential side. The offering memorandum, it looks something like this. It has rent roll, and also it has the financial analysis that they put together. Remember, residential, we do staging to make our client, the buyers emotional. For the commercial side, the listing agent would dress up the numbers to make it more emotional for investors to say like, "Ooh, this is good number." So, but then of course we have to do our own due diligence when we run our numbers as well. So now that I have these numbers, I'm going to run my quick analysis first. I don't go into my 10 years right away because that takes a lot of time. I want to run my quick analysis to see if this even makes sense for me to go into. So I just do a very quick, sometimes it's like a napkin analysis. I put down, okay, asking price $4.1 million, purchase price 3.9, the total monthly income, current, we have current rent, the current rent and also future rent here. So now we see that the total monthly, the annual rent is about $526,248. What you can see is that the average rent per unit here is $526. I'm saying that the future rent from my research is about $610. It looks like it's not that much. It's about barely $80 increase per unit. So, but this is what I want to share with you is that if you look at calculate the net operating income with a quick analysis, I always like Class C. I already know I would use my 45% expense ratio. That's how I do it. Some other people may not do the same thing, but that's how I do. I would use 45% expense ratio and then calculate what is the estimated net operating income for this property. But if you look at this from increasing not even $80 per unit, you're increasing the net operating income by almost pretty much $20,000. So that's, and then $20,000, some people might say, like, it's still not that much. But what happened is that if I use the net operating income 289, and then I know the market cap rate over there is about 7%, then the property of this property is valued at about 4.134. So it is pretty reasonable with their asking price. If I do another calculation, would be like that equivalent to 7.4% cap if I purchase it at $3.9 million. So because my purchasing cap rate is higher than the market cap, I think this is something I can consider and recommend to my client. But what I love about this is that if you see by increasing not even $80 a unit, the value increase by using the new net operating income divided by the cap rate, market cap rate 7%, you increase the property value by about almost $300,000. So that's the power, right, of these income approach. So now the number looks great, and that's why I would recommend this to my client. And then I'm going to run my 10-year analysis. Now, remember, we had this financial analysis from the listing agent. And what I now need to transpose this number into my own analysis. We call it annual property operating data, APOD, which looks like this. So this is something like on this book, we use like all these, we actually, when we take the class, we handwrite all the numbers in there. We do a lot of case studies, and we understand every single cell. I didn't use computer when I first learned this. I actually handwritten all my numbers, used my calculator, and added all the numbers together. So you'll see that on this sheet, of course, we have some property data here, and then we have this assessed value. We have the 25% on land and 75% on improvements. Then I transpose these numbers here. What I want you to pay attention to is that you have to, this is your first part of due diligence. Look at, if you look at the numbers here versus the numbers that the agent had provided, especially the $16,000, the real estate tax, $16,194 compared to mine. They use the current real estate tax, the property tax, but we need to make sure that we're providing the right number for our clients when we run the analysis. So mine is $39,000. That's a huge difference. Another one is that the insurance, they are at a higher insurance, $30,000, but we were able to run our numbers with our insurance broker, and they gave us about $20,000. And then the management expenses, they were at $48,000, and then ours is we broke it down into two. It's like one is 19,576, which is based on the management fee, about 5%, and then plus the payroll because you will need an on-site manager. So our numbers adding up is not too far off, but I just want to show you that there is some difference between our numbers and their numbers. And lastly is that if you total everything up, their expense is about $260,000, but our expense is about $285,000. So that's why it is important. This is our first due diligence to make sure that our numbers, we have run our numbers to see that the numbers that the agent had provided us make sense. Okay. Oh, I want to go back to this sheet. The reason why we're running this sheet is that we are trying to see what we are looking at as soon as we purchase this property and what is the financials going to look like before we even raise rents, because this is based on potential rental income. Is that this income is based on what we will get, like this, the actual numbers that the seller's been getting before we even raise rents or anything else. And then another sheet of this analysis is that we need to put in our assumptions, because without assumptions, you can't really run your 10 years, right? So I know that my clients is at about 35% income tax bracket. The capital gain tax, of course, is 20%, and the straight line recapture is about 25%. And then we have vacancy rate. This area I put down 7% here. Rental income escalators, like every year in the beginning of the year, I see that we can probably raise rents a little bit more, but then on going forward, they've been raising rents just about 4% in that area. So this is why I put down 4% and for the rest of the rest of the years. And then other income escalator could be laundry income, it could be parking or storage. So I just put the standard 3% for my own analysis. And the expense escalator, same thing. I just put 3% expenses, assuming that every year there's some expenses increase. And this one, the last part, is that we want to do 3 different analysis for our clients. I mean, 3 different numbers is more like aggressive, moderate, and conservative. So we were saying that by the end of 10 years, if our clients want to sell, you can do either 5 years or 10 years. I typically do 10 years because most of our clients like to hold longer. Then it could go from 6.5% cap, 7% cap, or 8% cap. And then we're going to see what is their return IRR is going to look like in the future. Now, before we go into the IRR, we have to run our now 10 years cash flow. Daniel, how's my time go right now?
We're at the half hour, so you're doing great.
Okay, good. Okay, so now I can slow down maybe a little bit. I thought I was running late. So this is the 10 years cash flow that I use, and this is what it looks like. It looks it looks like a lot of numbers. Again, as I mentioned before, this sheet, when we were taking the CI 101 class, I filled this in by pencil. I did not use a computer. Every single cell here, I would add it in myself, because this is how you can understand how it works. And that goes back to what Bruce Lee was saying. You want to practice the same thing 10,000 times. And that was the reason why if you immediately use the computer to generate these, it's not going to make sense. But if you can actually use pencil in every single year, every single cell, now you know how these numbers come from. Okay. So this sheet looks pretty overwhelming, but I'm going to separate it out into different segments. There's mortgage data here. There's this table where it shows our cash flow, because it also included the taxes, how much tax we're expecting to pay. And also you'll see that there's 11th year all the way to the right side. The reason why we have that 11th year is because assuming we own these for 10 years and at the 11th year you're going to sell it, then you're going to use the 11th year number, right, to put it on your offering memorandum. That's why we have the 11th year number there. And then we also have this cost recovery data. This is the depreciation, because when we calculate your taxable income, we're going to deduct the depreciation of the property. Okay, so now go into detail about the mortgage data. The mortgage data here is where I can run my numbers before I even talk to the lender, saying like, okay, how much loan amount you probably can get from this property based on the numbers that we ran on our annual property operating data sheet, the APOS sheet. So I ran my numbers here. There's this debt service coverage ratio. debt service coverage ratio, it means that the debt service is the annual mortgage payment. So your mortgage payment times 12, and then your net operating income here. So how much of this net operating can cover your annual mortgage payment? Because the lender, they want to know, right? Can your net operating income sufficiently cover your mortgage payment and still have a little bit more room for some unforeseen expenses? So that's why a lot of times they want the debt service coverage ratio to be at least 1.25. Right now, I've seen that something at 1.15 when the market was really good, but now probably the mortgage lender, they're asking for a little bit more higher numbers, but that's 1.25 is pretty standard. So from when I ran my number based on a 77% loan to value at $3 million, then the debt service coverage ratio is 1.35 based on knowing what is the rate and what is the amortization period and loan terms. We actually got a quote from Freddie Mac loan, and so we were able to get a 30 years amortization and a 10 years fixed for 4.2% interest rate, and they were actually allow us to go all the way up to 80%. So at the end, my client got this property at 80% loan to value, which is really amazing. And then the bottom part here, the cost recovery, is the depreciation. So if you remember on annual the APOD sheet, we had talked about like the assessed value of the property, how many percent is the land, how many percent is the improvement. Remember, one of the advantages to being a real estate investor is that you're allowed to do depreciation, right? So that's why we have this cost recovery data, because we want to know how much depreciation we can take out every year. So for residential, no matter what number of units, you get 27.5 years, while commercial, you divide by 39 years. And this is also why people like to do residential, because you are dividing it much less than the commercial, so you get more depreciation every year. Okay. Oh. Next one. Here we go. Now that giant tables that I had earlier, 10 years, I cut it down into 3 years just so that you guys can see better. So this is what we are trying to look at, is what is the taxable income for this property after all the expenses and the depreciation. So you see that we basically condensed it, and then we have this net operating income, and then every year, of course, it goes, then we have that increase, remember, because we have the rental income escalator, and then we have the other income escalator, we have the expenses escalator here. Then you have the interest, because you're paying mortgage, so you get to deduct the interest as well, and you get to deduct the depreciation as well. So this is the depreciation schedule that we have. The first year, it was not a full year, that's why it's a different number from the rest. And also we get to amortize the loan fees as well. So this is how we calculate the taxable income. And then based on our clients, if they are at 35%, this is how much tax they're expected to pay. And the cash flow here is the net operating income minus now net operating income does not include the mortgage payment, right? So that's why here, if we want to know the cash flow, then we need to minus the mortgage payment here, which allows to calculate what is the cash flow every year before you pay tax and after you pay tax. I think this is why I love CCIM analysis, is that after I took my CI 101, I learned this. I told you how I used my pencil, hand filled everything, and then I started using my computer to run this for my clients. That same client, it just blew her mind away. It's like, wow, you even calculated based on the before tax and after tax. It's very rare that any other commercial agents would actually do that for them. Of course, we are not a tax, we are not a CPA, we're not a tax preparer. And funny thing is, my client is actually, she's a CPA. So, so I can tell her that, like, this is just my estimate, but obviously she should consult with her tax preparer. But this actually gives her some idea what she's going to look into for the next 10 years of her cash flow. And you can run your assumption based on what you think you can do to the property, what kind of value adding you can do. Is it that you can cut expenses, or can you increase rental income? Different things that like that, you can put together your 10 years cash flow for your clients to see what they're looking at. So now you finish this, this table or this sheet, you go into the next sheet is to see what is the value is going to be like by the 10th year when she's going to sell it. What is the sales price going to be? Remember, we talked about we have three different scenarios. Three different scenarios based on what you can sell at the 11th, based on the net operating income on the 11th year. So the net operating income in the 11th year is $470,000, and divided by the cap rate, which is what we had initially. We talked about, like, we had three scenarios: 6.5% cap, 7 cap, and 8 cap. So that's the numbers that, of course, sometimes you might work with your clients. Your clients like, no, I think the cap rate is going to be this, and you just have to use. Nobody can really predict, right, in the 11th year, but you just have to use your best judgment to come up with the numbers that are agreeable between you and your client. And so using that net operating income divided by the cap rate, these three numbers are the numbers that we think we can sell it at the 11th year. And now we're going to calculate the adjusted basis, because we also need to know at the end if they are going to pay tax. They're not doing 1031 exchange, how much tax they're going to pay, or if they're going to do 1031 exchange, how much cash they're going to get to exchange in another property. So we have to calculate based on their adjusted basis here. They bought the property for, I think it was $4 million plus some fees. That's why the basis is at $4 million. And then minus the depreciation that they have taken before. So that's why you have to minus back in, meaning now the basis is lower. So if they sell higher, they have more gains because they had taken the depreciation. Now the capital gain here is that the sales price, assuming we can sell at 7.2, we're using this scenario, 7.2 minus the cost of sale, the commission, the closing costs, etc., and then minus your adjusted basis of your property, of the property value. This is the gain that we calculate by, it's approximate, this is the gain of the property. So minus the straight line cost recovery, this is basically is talking about the capital gain that you had gotten. Then your capital gain from depreciation is about $2.8 million. So using this capital gain, now you can find out how much tax approximately that they will need to pay. So now here we're going to calculate the sales proceeds. At the end of the day, they want to know how much money I can get. The sales price is 7.2 minus the cost of sale again, minus the mortgage balance by that time, by the 10th year, at the end of the 10th year. Your sale proceeds, the cash that you actually pocket, is about $4.4 million. But then if you are going to pay tax, you're not doing 1031 exchange anymore, your client said, I'm done, this is it, then you're like, okay, you probably will have to pay about $243,000 worth of the tax on the depreciation recapture, and also the capital gain tax on whatever gain you have made. So the tax that she will have to pay is about, this is $800,000. So a lot of times when clients see that, it's like, oh my God, I have to pay $800,000. Never mind, I'm just going to roll into another property. Now they have $4.4 million worth of cash that they can use to roll into another property. And just imagine if this is like a 20% or 25%, you can roll into a much bigger property in the future. But again, you can use three different scenarios here to run the numbers. So let them know, it's like, this is more my aggressive number, this is my moderate number, and this is my conservative number. And clients absolutely love it, because you're not giving them they see that, oh, you're running different scenarios for me, so that you're not over promising me the numbers, right? And then at the end of the day, numbers, what does it mean compared to what kind of return I can get with this compared to stock markets or other stuff? So we use this T-bar on, again, three different scenarios just now. This top part is before tax, like assuming if she or he are gonna do 1031 exchange, and this is after tax return, assuming that they will be like, okay, I'm done, I'm gonna pay tax, and what kind of return they're gonna get. So remember, in the beginning, she paid about $1.042 million into the property as an initial investment. And then the next 10 years, these are the cash flow that we're expecting. And then the sales proceeds that she's going to get after they sell the property and we calculate the IRR is about 24.7%. This is an aggressive model. And if they had paid tax, it would be about 20.73% for this model. Or conservatively, if it's still at 8% cap, then they might get about 22% and 18% after tax. So these numbers, I mean, this looks amazing, these numbers. That's why my clients are like, oh my gosh, I definitely would love to buy this property. But then sometimes like you might see the numbers could be like 8%. And we have clients that are like, as long as it's over 5%, I'm good. Just give me anything that's over 5% IRR. Or we have clients saying, like, nope, I need something that at least 10%, then we will look at it. And then we have other clients like, well, if I'm buying in this area, I need to have at least 20%. Otherwise, I'm not going to go into it. So this is what, at the end of the day, this is what we want them to see. So all those numbers that we put in the front is for this sheet. And so I always say this is the most important sheet for our clients to look at. Okay. Here we go. Is this how you guys feel right now? Too much information, brain overflow, don't know what happened, don't know what's going on with all these numbers. When I finished my CI 101, 4 full days from 8 all the way to 5 p.m. every day. That's how I felt. Literally every day I had a really bad headache, but it was a good kind of headache because there was so much good information. But it's okay. You know, I know you might say, like, now I have a deal I want to do, but this is too much for me to learn. Then refer it out, get a 25%, whatever, 30% referral fee, why not? Or just partner with somebody who has experience on the transaction. I tell all my new agents the same thing. When you first started, you don't know what you're doing, and you are not just selling a cup here or a grocery here. You're selling a property as somebody's investment, somebody's future here. So please be their consultant. I work with somebody who has the experience. And I always say teamwork is the most important thing. You don't want to do things on your own. I would say 90% to 95% of my transactions work with somebody. I don't take a transaction on my own because I truly believe that, talent wins the game, but teamwork and intelligence win championships. I know it seems like, wow, I have to split my commission with somebody 50%. That seems a lot, but that's how you can grow your bases, and then you can continue to get referrals. Not until this year, I just decided I'm going to start to pay for some marketing fees, but my career have been going on with referrals only. So really try to make sure that you're providing quality service to your client, and instead of just focusing on the money.
Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments, because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching, and I'll see you next time.